This is Business Weekend with Edward Boyd.
Hello and welcome to Business Weekend. I'm Edward Boyd. Coming up, on Thursday, the Liberal Party formally abandoned their commitment to net zero carbon emissions by 2050. Now, this decision came after months of infighting and a mammoth party room meeting. So, what does it mean for energy policy in Australia and the outlook for power prices? Energy expert Saul Cavendish will explain the details.
To be very clear, net zero 2050 is impossible, but we have lots of political targets and ambitions which are impossible, but they're still nice things to say, and the world moves on.
One of Australia's biggest users of gas is the explosives and chemicals maker Orica. This week it reported its best earnings result since 2012 thanks to strong demand from the gold mining sector. But CEO Sanjeev Gandhi says Australia should reconsider its commitment to net zero by 2050. He thinks 2060 or even 2070 is a more realistic target.
So having a hard target of 2050, I don't think that's very sensible, but continuing on the journey of decarbonisation is exactly the right thing to do.
Plus, two of the market's hottest stocks, the defence business DroneShield and critical minerals developer Hyperion X, have both been smashed by investors this month. We do a deep dive into why these two companies have both been savaged by the market with one of Australia's top fund managers, Steve Johnson from Forager.
It's a much bigger issue for the retail investors that have followed this bubble and piled lots of money into it.
And later in the program, we'll speak to the CEO of accounting software company Xero to cover off its recent profit results and discuss the outlook for Australia's iron ore sector with a credit analyst from S&P Global. But first, billions of dollars were wiped off Australian and US share markets this week after rates traders pushed back expectations for interest rate cuts. The US Federal Reserve was expected to cut next month, but now, with an uncertain economic outlook and higher than expected inflation, the chance of a rate cut has fallen below 50%. In Australia, there's only a 5% chance of a rate cut next month, and that's due to the stronger than expected unemployment numbers which were released on Thursday. 42,200 jobs were created during October. That was more than double what the market was expecting. It pushed the unemployment rate down to 4.3%.
I don't think there's any real serious chance of a rate cut in December. I still think, though, that next year, if inflation, after Q3, if inflation comes back towards the middle of the target band, there is a chance of further policy easing next year. But the RBA is not going to be any rush. They're going to wait and see. They were pretty nervous about inflation in Q3. They're going to wait and see where we go in the end of 2025 and early next year before any policy easing next year.
The key global event that happened this week was the end to the 43-day US government shutdown, the longest in history. America's debt recently exceeded $38 trillion US. The government now has a line of credit until January 30 after President Trump signed the bill.
It's an honour now to sign this incredible bill and get our country working again. Thank you.
The Liberal Party have officially dumped their commitment to net zero carbon emissions by 2050. Former Prime Minister Scott Morrison agreed to it back in 2021 at the COP climate conference in Glasgow. But now, after the Nationals abandoned net zero earlier this month, the Liberal Party have followed suit. Leader Susan Lee says her party will focus on cheaper power prices for Australian consumers.
Australians deserve affordable energy and responsible emissions reduction. And the Liberal Party believes we can do both.
So what does this policy shift mean for the energy sector, oil and gas producers and investor confidence? Let's bring in here Saul Cavendish, the Head of Energy Research at MST Marquee. Saul, thanks for your time. I mean, investors want certainty when it comes to energy policy. Does this just muddy the waters even more?
Well, the investment certainty and policy certainty that investors have craved has been elusive for over a decade now. The truth is the ditching of the net zero target is actually the easy part for the coalition, and it opens the door now for development of winning energy policy, which would be unencumbered by climate policy concerns. But the hard part would actually be what comes next. Energy is critical not just for our power bills, but for our manufacturing jobs, our critical supply chains, and also having an energy advantage to enable Australia to win in the global AI race. And the policy details to actually deliver that is still something that the coalition are going to have to formulate and put forward. It's worth keeping in mind that last decade, the coalition, also unencumbered by a net zero target, failed to do many of these things. And so they really are going to have to make the case for why it's going to be different this time and actually provide a little bit more detail around some of their headline announcements there. You can see, for example, I think Minister Dan Tehan has made a good effort to try and get some critical policy into what is ultimately a political announcement here, particularly regarding having a technology agnostic capacity investment scheme and having greater planning and timelines around coal phase out and what's there to replace it when that does happen. Those are some positives, but without the details, energy, I'm afraid, is a very detail-orientated business. If you don't get the details right, it doesn't matter what your target is in 2050 or at any other point for that matter.
Yeah, the Liberals are meant to be meeting with the Nationals today to figure out a new energy policy going forward. But what should they focus on? I know nuclear was something that was really the focus of the election earlier this year. Do they need to get back to that?
I think what would be wise for the coalition is to get back to what the coalition was originally supposed to stand for, which is a focus on markets, choosing winners and losers rather than governments, and putting together frameworks to allow the market investment to work in a private setting rather than the government constantly coming in and intervening every political cycle, which just makes the overall investment climate work. So to that extent, having a capacity regime, which has been recommended by pretty much every review going back a decade, actually putting something like that in place could be positive, provided it's technology agnostic and a market-based mechanism, unlike, for example, Labor's capacity investment scheme, which has ideologically excluded the lowest cost capacity in many instances, which is gas. But I think we also need to look at there's some concerning signs of what could come out of coalition policy here, particularly regarding direct action and government support for CCS, where they're replacing what's a market-based mechanism in the safeguard policy with more higher cost government directed action, which is still a carbon cost, imposed directly on taxpayers. And so there's a mixed bag in what they've suggested is going to come out already, but we do need to see more details before we can judge it more fully.
Yeah, later on in this program, I'm going to speak to the Chief Executive of Orica. They've been awarded more than $400 million from the government to build a hydrogen hub near Newcastle in New South Wales, but the CEO's yet to make an investment decision on that. He says it's not economic yet. Is this kind of one of the policy failures you're hinting at?
And there's been so many policy failures we've lost count. Our green hydrogen initiative, which has thrown hundreds of millions, actually billions in some cases, to waste on things that were impossible from the get-go, is just one of them. A capacity investment scheme announced by Bowen's office, which didn't have the details for a year, and now has been picking losers and crowding out winners, and excluding things like, ideologically excluding things like gas from the mechanism, have been a failure. The multiple interventions in the East Coast gas market, which the government's own regulatory departments now acknowledge, has resulted in less investment and less gas coming into the market. These are just a small sample of some of the failings we've seen over the last few years. I mean, the challenge for the coalition is to actually come up with something better. And again, when we focus on a net zero target 2050, which on our estimates could cost the Australian economy upwards of $1 trillion, it's all very well and good to say, well, we're going to remove that target. But the truth is, no one who's currently in political office is going to be held accountable for what happens in 2050. What Australians need to know is what's the policy you're putting in place for the next 5 years, which is going to bring our energy advantage back, bring our jobs back, make us win in reindustrialisation, critical supply chains and the AI race. And that's something that we need to see tangible, concrete policy on now, and not so much of a focus of what a political target is in 2050, which is probably impossible to achieve anyway.
Yeah, I was going to ask you as a side note, is it actually realistic or is it achievable net zero by 2050?
To be very clear, net zero 2050 is impossible, but we have lots of political targets and ambitions which are impossible, but they're still nice things to say, and the world moves on. And I really think there's been, seeing the coalition tear themselves apart over this issue, when what is most important to Australia's economic advantage, national security, and people at home is what's going to happen in the next few years, right? So we need to have a plan for what is going to re-energise Australia's industrial base, bring down power prices, and create a situation of energy abundance again. And a target in 2050 has no bearing on that if it's not accompanied by clear, concrete policy, which is going to have an impact now.
And really quickly, does that include projects that are stalled like Narrabri in New South Wales?
Well, I think one of the most critically important elements of any policy is going to be our approvals landscape, where we have to become a nation of go instead of no. We've seen our regulatory departments, things that used to take 2 months to be approved are now taking years. There's too much inertia and hostility within government to get things going again. And we need to see approvals, not just like projects like Narrabri, but across the board, gas, coal, power and wires, renewables, you name it. We need to be able to actually build and do things again and stop just saying no to things. That regulatory balance between facilitating investment and regulating it needs to come back to a sensible centre. We're too focused on regulation and stopping things these days.
Saul Cavendish, great to have you on the show.
Thank you.
One company which aspires to reach net zero emissions by 2050 is the explosives and chemical manufacturer Orica. But its CEO Sanjeev Gandhi is realistic about the target. He thinks it's a great aspiration, but says it's based on technologies which do not exist yet. Orica is attempting to find an economic partner for its hydrogen project located at Kooringang Island in New South Wales. Despite being granted more than $400 million in funding for the project, Orica is yet to make a final investment decision. I spoke to Mr. Gandhi earlier this week about net zero, hydrogen, and Orica's record profit results, which were partly due to strong demand from gold miners for the chemical sodium cyanide.
It's been a positive macro, as you can imagine. More the demand, higher the pricing, they need more services from Orica, and we are happy to serve the gold industry. So it's been good times.
Yeah, your results mentioned strong demand for premium products. Just talk us through what those premium products are and who's buying them out there.
So you see the macros in the resource industry are such that there's a good demand, there's not enough supply. And the reason is clear, because this industry has underinvested in developing new resources, in investing in exploration, in getting new products into the market. Supply on the other hand, demand on the other hand is consistent, it's growing, it's driven by macros like decarbonisation, like the demand for data centres, copper, power transmission, gold obviously as a safe haven, and there's just not enough supply. So prices are going up, and customers are looking for three things. They're looking for productivity, so they want to produce more with what they have. They're looking for cost efficiency, because obviously everybody suffers from inflation today. And then they're looking for license to operate, ESG, safety value propositions, and the other stuff around that. And that's what Orica does. That's where we play. So we've got these special products and services customized for a commodity, customized for a type of mine, customized for the nature of mining, which can help them to improve all three: productivity, costs, and ESG. And obviously these products come at a premium, and we've seen a very strong uptake of those products and services from us.
Yeah, earnings from your Australian and Asia Pacific division up 23% during the year. I mean, how tough has it been for you keeping costs down over the past 12 months?
Extremely challenging, and this is not just a 12-month story, it's been a story over the last 5 years. We are struggling with inflation, we are struggling with higher energy costs, higher gas costs, higher labour costs. We've got inflation through every component that we consume and we offer to our customers. And you have to manage to mitigate that inflation, manage those increasing costs, and then still grow your earnings and provide the best services you can to your customers. And that's not an easy game. So it's been a real challenge for us, as it is for every industry in this country.
All right, you've also got divisions in other parts of the world, particularly, North America. I think we spoke previously about Trump as the new president last year, the drill baby drill mantra. I mean, how have business conditions been in the United States compared to Australia?
Well, my sentiment is the same. I'm very optimistic and bullish on the United States. Now, obviously, this government shutdown has put us back a little bit, because a lot of these federal policies, the funding has not yet flown through. So we are waiting for it to come through so that it translates into better business for us. But the signs are great, right? There's a lot of support for the oil and gas industry in the US. The US has got one of the lowest energy prices in the world, which is extremely attractive for heavy manufacturers like Orica. They've got a lot of resources. They've got a lot of copper and gold. And, we made investments in the US. We've made the acquisition for sodium cyanide in the US. So we are playing in the sweet spot here. We are a market leader there. So we are just looking forward to that demand taking off so that we could benefit and continue to serve our customers in the United States.
But would you say business conditions in America have improved over the past couple of years?
Sentiment has improved. Permitting processes have improved. We still struggle with a few things. We struggle with labor availability, for example. It's quite expensive to hire people. And mining is a very labor-intensive industry. So, even getting basic facilities like good drivers to ferry your products to and fro from mine sites is not easy, and it's expensive to get. So labor productivity is a bit of a challenge there, and labor availability. Now, the crackdown on immigration obviously is not helping, because even the US as a destination now to bring in people is not that attractive anymore, given the new labor the policies there. So that's the challenge that we have to manage. But overall sentiment is positive, and it continues to improve there.
Okay, in Australia, the big political issue this week's been the Liberal Party abandoning their commitment to net zero by 2050. I mean, what's your reaction to that, knowing the Albanese government is still committed to net zero by 2050?
I look into the nuances of this decision, and I think it's all about supporting Australia in the end. It's about supporting manufacturing in Australia. It's about managing a transition which is difficult, which especially in industries like Orica is a hard to abate industry. It's expensive to abate, and it's not a linear journey there. So I think the intention there is to defend and protect manufacturing in the country. The intention is good, but Orica will do what Orica does, which is good for the environment, which is good for our shareholders and our customers. We've started on the decarbonisation journey much before regulations came into Australia, so in 2016, 17, 18. And then we had the safeguard mechanism that basically hardlines for the top 215 emitters in Australia, one of them being Orica, that we have to reduce our carbon emissions by 5% from 2029. Now, we are an early starter. We've invested more than 100 million in decarbonising our assets in New South Wales as well as in Queensland. We are generating a lot of carbon credits, which was part of the business case, and we are banking them at the moment, because as the safeguard mechanism hits, we would be below the threshold, and we will avoid penalties, and we will keep those carbon credits basically in future to protect us from any penalties. So we are a front mover. What industry does not really like is policy changing. We don't like the goalposts moving and shifting all the time, because my investments have a lifetime of 20, 30, 40, even 50 years. So we are aiming for decarbonisation. I don't think having 2050 as a hard target is a very sensible thing to do, because it's a long, long way away. And industries like ours, who are hard to decarbonize, we are depending on technologies that are not yet commercial on the outer edge of this journey. So those technologies have to become commercial, they have to become viable, they have to become feasible, and then we have to deploy them so that we can end with net zero. That may not necessarily happen in 2050. If I look at major economies like China and India, they've taken a more pragmatic approach. So, for example, they're talking about 2060, even 2070. I think that's a bit more realistic now. So having a hard target of 2050, I don't think that's very sensible, but continuing on the journey of decarbonisation is exactly the right thing to do, and Orica will not stop there.
Yeah, you talk about decarbonisation. Several months ago, you were awarded more than $430 million in funding to support the Hunter Valley Hydrogen Project. I mean, what have you been spending that money on? How's it been going?
We haven't spent a single cent there so far. What we have told the market, and our commitment to the government, is that in the first half of 2026, we would like to get final investment decision from my board, and then we'd like to start building this asset. At the moment, we are looking to find a partner, a joint venture partner, who will bring in obviously the capital that we need, share in the risks and the opportunities with us, but will also bring in renewable energy, because one of the major factors to make a green hydrogen manufacturing facility successful is cost competitive renewable energy. So we've been talking to global renewable energy suppliers, big names in the world, also in Australia, and we've asked whether any of them would be interested to join us. There's been a lot of interest because we've got funding. Ours is the most feasible project to be realized in this country, and our partners realize that. So we are in the process of shortlisting and negotiating with partners. As soon as we finalize a joint venture partner, the next step would be go to our respective boards, get the final approvals, and then start construction. My expectation is in 2028, we should have the first green molecules of hydrogen produced in the Hunter Valley. That's our plan.
And you mentioned boards. Next month, the annual general meeting, Vic Bansal's going to become chairman. What's it going to be like having him as the new chair of Orica?
Exciting. Look, I'm going to miss Malcolm because Malcolm brought me into Orica. Malcolm brought me into the country, Malcolm Broomed. And after a wonderful, successful tenure, he will retire. And Vic comes on board. It's quite interesting because we know Vic. Vic Borrell has been a good customer of Orica. And Vic is a P&L guy. He's run big businesses. He's got global experience. And that's what Orica is. We are a global company. We operate in more than 100 countries. We are very international. We've got sophisticated manufacturing, a lot of technology. And Vic is absolutely the right successor. But to qualify that, he has big boots to fill.
Sanjeev Gandhi, Chief Executive Orica, great to have you on the show.
Pleasure, Ed. Thank you for having me.
Coming up after the break, we do a deep dive into what has gone wrong at the market darlings DroneShield and Hyperion X with leading fund manager Steve Johnson from Forager. Plus, we'll speak to the CEO of New Zealand's biggest company by market cap, the accounting software firm Xero, about its growth aspirations and its takeover of the payroll business Miglio. Welcome back. DroneShield has been one of the hottest meme stocks on the market this year, rising about 700% from January until its peak in early October. The small cap stock became so big it cracked the ASX 200, attracting passive investors, which pushed the price up even more. But then fundies began to sell out, questioning its high valuation. The CEO, chairman and a board member all dumped almost $70 million of stock just this week, triggering a huge sell-off. So what's happened at DroneShield and other growth stocks like Hyperion X? I spoke to Steve Johnson, the Chief Investment Officer at Forager Funds Management, a little earlier.
Yeah, I think the most recent rationale is some very, very significant insider selling. They'd only just been given these shares for meeting some targets and sold more than $60 million worth of shares over the course of the past week. So that's the immediate cause for concern. Look, I'd say more broadly, DroneShield is one of quite a few stocks that I would call being in a meme bubble where they were very, very overinflated in terms of their prices, and it had started unravelling even before this latest meltdown over the past week.
Yeah, and when a company is in a meme bubble and they, for example, with DroneShield's case, it got into the ASX 200, then there's all this additional passive money that goes in and the cycle kind of continues and it seems to just push prices up higher and higher.
Yeah, it's been a huge factor over the past few years, and it's not just index funds anymore. You've got Australia's big super funds who behave just like the index funds. They're all trying to hug the index as well. So they can't afford not to own one of these companies once it goes into the ASX 200. I think in terms of the performance of those index funds and the super funds, though, these companies go in at a very, very small weighting. So it's not great for those funds that these companies come in, they have to buy them, and then they blow up and go back out. But it's fairly minuscule in terms of the portfolio weightings that they go in at. It's a much, much bigger issue for the retail investors that have followed this bubble and piled lots of money into it. DroneShield was the second most traded stock on the ASX yesterday, behind the CBA. It's an extraordinary amount of volume that's going through in a company that has a fairly small amount of revenue, and I would say is a small business with a huge amount of retail interest in it.
Yeah, it is a small business and it's one of those interesting companies on the market where the founder is the chief executive. It's sort of surprising to me, at least, seeing the CEO sell all of the shares that he owns in the business and just now has performance rights and options. It sort of seems like he doesn't maybe have confidence in his own company.
Well, there's the company and the share price, Ed, and I can tell you that if I was him, I'd be selling every single share in it as well. This company has just, the share price is up so much, and I think everyone, I'm a bit more sceptical, I guess, about the world than a lot of other people. I just look at it, this guy's gone, there's $50 million on the table here. This is a life-changing amount of money. They've done a really, really good job of putting out all of these pretty promotional announcements and getting the share price up, and the fact that people are surprised that they want to cash in on that, that's the one thing that surprised me about it all. I think with most of these really promotional stocks, the people that are behind it are looking to take money out of the situation at some point in time. That's why they want to push the share price up as high as they possibly can. So, sorry, I'm a very sceptical person. I've seen this so many times. I'm not the slightest bit surprised about them taking all the money off the table.
Yeah, I mean, if you do an analysis looking at DroneShield's ASX releases going back the past 12 months or so, virtually every time they put out a release announcing a new contract or a new deal with a customer overseas, the share price would spike 5%, sometimes 10%. But they actually slipped up a few days ago. They put out a release announcing a contract, but they'd actually already announced it back in September. So they had to withdraw an ASX announcement. That's something that I haven't seen on the market very often at all.
No, I haven't seen that particular case either, but I wrote this in an article recently for people on livewire.com that we used to have an ASX listed vehicle, and we can literally sit there and write an ASX announcement and you release it to the ASX and it goes up. People need to understand how easy it is for someone to actually just type those words into a computer, print a PDF, send it to the ASX, and it goes up on the ASX. So those words are a lot easier to write than it is to actually generate revenue and profitability for a company. And the one thing I'll say about DroneShield, I'd say it's actually better than some of the other meme stocks out there like Hyperion X, because it does at least have revenue, and these contracts seem to be contracts that actually turn up as cash in the bank at some point down the track. There are other companies that are even better at making announcements and not having any revenue to back it up.
Yeah, you mentioned Hyperion X, obviously a critical mineral stock, looking at developing projects overseas. Clearly, there's been a lot of investor focus this year as well on that critical mineral sector, as we've seen the trade war basically between China and the United States, and Donald Trump talking about it and having Anthony Albanese in the Oval Office a few weeks ago. What's that done with Hyperion X's share price?
Yeah, I think whether it's defence or whether it's critical minerals, we are in a very momentum theme-driven market and have been for the past 18 months, really. So especially on the ASX, I think there's a limited number of ways that people can play the theme that they want to play. And now we've also got these thematic specific ETFs that will own, on the ASX at least, a very limited number of stocks. So it's not just people buying a particular company, it's people buying a thematic ETF that then goes and buys the shares in the individual company. So yeah, in this particular case, again, like DroneShield, the defence theme is real, the critical minerals theme is real. My personal opinion, Trump's playing us a bit as a patsy. We're being used as a negotiating tactic with the Chinese to try and get the Chinese to not limit their own export of critical minerals, and that is probably going to happen. But yeah, the theme is real. The world is going to need more of these things, and companies that do a good job of capitalising on that probably deserve to trade at a higher price given the demand environment than you would have said 5 or 6 years ago. As soon as there is one of these themes, though, that is popular, you are going to get these companies that are just trying to capitalise on the momentum and the thematic, and you need to perform an analysis of whether there's something real behind the business. And my personal opinion, and this is just an opinion, in Hyperion X's case, there's been a lot of announcements. Its last quarterly update was $0 of revenue, and if you look back 3 years ago, the announcements were saying we're going to have revenue in 2024, we're going to have revenue in 2025. We still haven't seen a dollar pretty much of revenue. So that is one where I think you really need to start demanding evidence from this company that the promotional announcements that they've made can be backed up with some real audited financial accounts, which is a bit old school, but that's the thing that I like to look for.
Well, that's good, because there's been a couple of other sell-offs this week between Life360 and Catapult, but those are two businesses that are reporting revenue. It just seems like they're caught up in this big tech sell-off at the moment.
Yeah, there's a general theme, I think, of some of the things that have worked really well unravelling over the past couple of weeks. That's been true in the US, it's true here in Australia as well. But I think there's a really clear distinction between the businesses where there's not much behind them and businesses like Catapult and 360 where there's a lot of revenue, there's improving profitability and margins, there's cash flow starting to come in. They are both businesses that I would like to own at the right price. And in fact, we did own Catapult for most of the past 4 years, really, from 2022 right through to 2 months ago. It's a fantastic business. I think it's got a lot of growth ahead of it. But the share price went from 75 cents just 3 years ago to $7.50. So it was up 10 times over a pretty short period of time. And that was on the back of growing revenue and growing profitability, but it wasn't actually any more than we had anticipated when we first bought the stock. So I think alongside, is it a good business and is it a good story, you do need to look at the share price and say, well, what is this share price and valuation implying about how much it has to grow into the future? And I think both of those companies, the share price just got ahead of the fundamentals, and one of two things can happen. Either the share price comes back a long way and it becomes attractive again, or it trades sideways for a long period of time while the fundamentals catch up with where the share price is at. But neither of those are flaky businesses. They are real Aussie success stories that have got some global growth ahead of them, and we don't have a lot of that on the ASX. I'd be more wary about shorting some of those than I would some of these businesses that are much flakier business models.
Steve Johnson from Forager Funds, great to have you on the show. I really appreciate it.
Thanks, Ed. Good to be here.
Accounting software company Xero is used by small and medium-sized businesses all over the world. This week, it reported a 42% increase in full-year profit off the back of a 20% jump in revenue. For many years, Xero's been focused on adding more small business customers to its platform. But now, since acquiring the US accounts payable company Melio for about $2.5 billion in June, it's shifting towards higher value targets. Ross Greenwood spoke to Xero Chief Executive Sukhinder Singh Cassidy earlier this week and started by asking her whether Xero can be an Australian and New Zealand-based business long term.
Oh, it absolutely is. I mean, remember, we have a large portfolio of markets, and although the U.S. represents a large growth opportunity, we love that diversified revenue base that comes from having a flagship market in Australia and New Zealand, and then obviously very high growth opportunities still in the UK, very high growth rest of world. So we really do see it as a portfolio of markets, even though, of course, we believe that the US has a bigger opportunity to play in that portfolio.
Okay, because it strikes me that trying to get access to coders, trying to get access to cheaper tax rates, trying to get access to deeper pools of capital, they're all there in the United States, and they might not be in the same proportion here and in New Zealand.
You know, I would argue that we have access to plenty of capital here on the ASX. If you look at what we achieved with the financing of the Melio acquisition, I think we have a very large shareholder base, lots of access to capital. I think your point about access to talent for areas like AI and so on, of course we will tap into Silicon Valley as we need to. But one of the things that's most attractive about Xero, believe it or not, is its global scale. And we find that that's very attractive to candidates, including candidates in the United States.
Okay, so you mentioned artificial intelligence, generative artificial intelligence. You're running down that path very rapidly. My question there is whether it's a disruptor to your business or whether it's an opportunity.
Well, you know, of course, we think because we're a system of record company that deals in complex workflows for small businesses and accountants and bookkeepers that they always want to be easier. AI is a net opportunity. Why? Because it gives them back hours of productivity. I mean, historically, software like ours would not only hold your financial data, but it would assist you in doing the job. Now with AI, the job can be done on your behalf. A good example is bank reconciliation, right? In bank rec, we are going from assisting you in you doing it yourself to now a leap with generative AI, where now we can auto reconcile on your behalf. So if you think about the amount of time savings and intelligence we can give in a platform, it for sure expands the pool of TAM, we think, in our market size and opportunity. Now, we would be, I would say, like any company in this era as a technology company, I think it would be silly not to be paranoid about the disruptive potential of the technology. But we think Xero can be a net winner because of what AI does to expand the value we create for our customers.
Okay, then the other thing I want to talk to you about is I can see growth now out of getting more subscribers in the United States, adding on additional services that I, as a small business, medium-sized business owner, will pay for. I can see that you can potentially get some efficiencies out of generative AI that could cut your costs a little bit. But it seems to me like your administrative costs are up quite sharply in the past year. But unlike banks, which didn't have much, sort of top-line growth, you had strong sales growth during that period of time. But is there a moment in the future at which you've really got to start to look and rethink where your growth opportunities come from?
You know, I think we believe we have plenty of TAM. When we did our investor day, we talked about $100 billion in TAM in the jobs we do for small businesses and the markets we serve. So I don't think we're running out of TAM. Now, you noted the very important thing, which is the expansion of not just subscribers, but penetration of our subscribers with new services, the ability to expand up into that larger small business segment. So when we look at all of the places to grow from, the segments we serve and the services we can provide, in addition to the subscriber growth and the relatively low penetration of cloud-based services, you know, in the spaces we play for small businesses, we're not really worried about the available TAM for quite a few years to come.
Okay, so is it also true that as a small business owner, if I'm using your system, it's a big jump for me to try to move to another system? In other words, what you've got me with a price point, an inflection point that's good for me, I'm happier staying there than perhaps shopping around going somewhere else. Do you sense that in your customer base?
Well, look, we historically are what we call a resilient business with low churn because our customers are trusting us with their financial data. So I think it's important to recognize as a system of record, you both have a big opportunity to serve customers. And yes, I don't think they like to move their data around easily, but I don't think you should ever take that for granted. I think your job is to continue to give them more and more value on top of that core data that they trust you with. Our job is to give them insight on top of that data. It's to give them accounting services, tax services, payroll services on top of that trusted position. So I don't think you ever want to take that for granted.
So the thing that also struck me about your results is that the average revenue per user is relatively low. It's not massive. And so surely you would think that there's growth opportunities there. Is that by adding more businesses or is it simply by raising prices eventually?
Well, interesting, it's about adding more services and functionality. So if you think about average revenue per user, which I noted is relatively low, there are high-value jobs like payments and payroll. When you add those jobs, the ARPU of those individual jobs is often bigger than the size of the accounting job in some of the markets we serve. So in particular, as an example, the U.S., almost everywhere in the world, payroll is a very highly valued job. And it's even more value when you're talking about small businesses, let's say, more than 20 employees. So I come back to this idea that there is plenty of ARPU value, like value in how you monetize these jobs because they are very valuable to our customer. So although ARPU is relatively low today, you'll notice that we, over the last 3 years, have been steadily, I would say, realizing more value from our customers by giving them more value in some of these services.
And just on the United States, can I just ask you about tariffs and where they sit? Quite clearly, a lot of companies have obviated tariffs by having operations in the United States. You have got operations, it's relatively small compared with what you're developing in Australia and New Zealand. Is it a point that you may need to defend your revenues and your bottom line in the future by having more operations in the United States?
Right now, if you look at tariffs, they've been very much focused on goods-based businesses. Tariffs do not apply to digital services like ours. So I think that's not really something we have in our consideration set. Of course, we have operations around the world, but this is less driven by tariffs. It's more driven by where we have access to talent and, of course, the markets that we serve. We often have employees in the markets that we serve as well. So I think that's really what drives our location strategy.
And just a final one for you. You get very rich data, general data, about the health and the state of small business in particular in different countries. Quite clearly right now, the outcomes in the United States seem quite different to what they are in Europe or to what they are in Australia. What's your own sense about the pecking order of the world in terms of economic growth and the health of those companies?
Well, it's interesting. You're right that we have our own data sets, and we create a report called XSBI that gives us a macro view of the markets in which we operate. What we see in Australia and New Zealand, believe it or not, is a modest recovery. We see some increases in sales by small businesses year over year. It's a little bit more pronounced in Australia, but even in New Zealand, we see slight, modest signs of recovery. In the UK, you actually see the UK holding relatively steady when it comes to small business sales from our data. And then in the United States, we haven't done our most recent survey yet, but what we see from the National Federation of Businesses is the Small Business Optimism Index remains near all-time highs despite tariffs and uncertainty, which I think is interesting in and of itself.
I'll tell you what, Singh Cassidy, it's always great to chat to you. Gets your insight from here and around the world, and many thanks for your time today.
Thanks so much, Ross.
After the break, Australia's iron ore miners are starting to diversify their businesses in the face of falling demand from China. Richard Creed from S&P Global is up next. Welcome back. Global steel production is edging lower, partly due to weakening demand from the iron ore hungry China. Despite the fall in output, the major iron ore producers are increasing production, which will weigh on the commodity price and the federal budget. The big companies like BHP, Rio and Fortescue are starting to diversify their production ahead of this structural shift in the commodity markets. For more on this, I'm joined by Richard Creed, credit analyst at S&P Global. Richard, thanks for your time. Just want to start with that diversification strategy that the big iron ore miners are on. What are they doing to diversify their businesses?
Oh, thanks, Ed. What we're seeing is that after many years of iron ore powering their earnings, they're looking to diversify as steel production in China has basically plateaued. So when they're looking for growth, they're now, in the case of the integrated miners, they're pivoting towards commodities that will benefit from the energy transition, such as copper. In the case of Fortescue, they're pursuing a decarbonisation strategy to make their output more attractive to the Chinese steel mills who are also seeking to decarbonise.
Yeah, I've looked at your report and it does show steel output falling from China, but picking up from some other places like India. But is there going to be emerging economies like India that will be able to pick up the slack, or is the sort of the iron ore boom now really coming to a big end?
Well, it's really plateauing, we think. So China accounts for more than half global steel production. So even though emerging economies like India are increasing their production, it's really a fraction of what China does. So China produces over 1 billion tonnes of steel, and India is looking to grow to sort of 140 to 150 million tonnes. So it's just over really 10 to 15% of China produces. So what China does will drive steel production and will drive the iron ore demand.
And what are the big changes that have been happening in the China economy over the past couple of years that are causing this plateau in demand for steel?
Sure. Well, if you go back to 2022, you can see that housing demand was for about 300 million tonnes of steel consumption. Now our S&P Global Market Intelligence business is projecting that next year that demand will fall to about 200 million tonnes. So that's quite a fall, and that's really driven in the softness of the housing sector in China, which we expect will continue given the demographic trends that are in that sort of country. So all in all, we think that the Chinese steel production is likely to begin to edge down over the rest of the decade. It will still be quite material, and so the demand for iron ore will be material, and so iron ore will be a very important part of these businesses going forward. But it's really about looking for growth and diversification for these businesses to keep them to keep their earnings stable as they fund that diversification strategy.
Yeah, I remember at profit reporting season in August, a couple of the iron ore miners here on the ASX talked about this new big hydroelectric dam project that China were going to start building in Tibet, and they were suggesting that would be a really big driver for steel production over the next decade or so.
Yeah, we think so too. That could well be a demand pull-through piece, but you have to remember that that's just one part of demand for steel in a very large economy. So even so, wider trends like what's happening in the housing market and just more broadly infrastructure spending and the ability of China to continue to push steel into its finished products, particularly autos and the like, and it's currently exporting 100 million tonnes a year. So all those trends and what happens in those segments of the market will be at least as important as big new infrastructure projects as well.
All right, so where do you see iron ore prices going long term?
That's the tricky question. So we don't generally for our credit ratings, try and project the prices exactly. What we do is we try and triangulate around what looks like a reasonable assumption for our credit ratings when we determine our credit metrics. And at the moment, we see about $90 for next year being an appropriate assumption, reflecting that softening of the Chinese economy and the demand for steel in the housing sector. So, and that compares at the moment to the current price of about just over $100, and over the last 12 months, it's really ranged between $95 and $105. So, not a huge change at the moment. It's just really edging down for the near term. In the longer term, some of those structural trends about increasing supply from the majors, what happens to Chinese demand, and also the decarb strategy in China will also play a part in the demand for iron ore and the sort of ore type that they're looking for.
Yeah, and obviously we've just seen the Simandou project in Guinea has had a big opening ceremony just recently. That's exactly a huge additional part of supply going into the iron ore market at a time where the other iron ore miners are boosting production as well. I saw in your report Vale in Brazil are looking to really ramp it up as well. So could prices potentially go down even more in the future with a bit of a supply glut potentially happening?
Yeah, that's absolutely a risk. So we see Simandou at full production being about 120 million tonnes by the end of the decade. So that really could cause a structural change in the market at the margin and cause prices to edge down. And if indeed that was to happen, then those iron ore producers that are higher cost, that are smaller, they may well face the full brunt of those structural changes. It's important to recognise, though, that the major iron ore producers are pretty low cost. So even if prices materially move down, they will still be profitable, just that they won't make as much money. But there could well be a structural change in the industry that the smaller producers are more exposed to, and those that have got a lot of leverage and a lot of debt, they are probably the most exposed. So we would expect lenders to be having a careful look at their portfolios and who they've got exposure to over the coming years.
Richard Creed, credit analyst at S&P Global. Great to have you on the show.
Many thanks for having me.
And that's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget, you can keep up with all the latest business news with our daily program, Business Now, at 4:30 p.m. Eastern Daylight Time. Thanks for your company. I'm Edward Boyd. We'll see you next week.